The chairman, 8th Global Conference on Business Management and Social Sciences 2022. The entire crew members, the distinguished academia there present, distinguished presenters, good day to you all. I am Aishat Salawudeen. Aishat Salawudeen is a PhD holder in accounting from Bayero University, Kano. MSc holder in accounting and finance from Ahmadu Bello University, Zaria, and BSc holder in accounting from Usman Danfodio University, Sokoto, all in Nigeria. I'm a certified national accountant, a certified financial analyst, a lecturer in the Department of Accounting, University of Abuja. Thank you for the opportunity to present a paper titled Dividend Payout Trend, an analysis of listed manufacturing firms in Nigeria. This study is structured into 5: introduction, review of empirical studies, methodology, result discussion, conclusion, and recommendation. Dividend policy is a financial policy regarding paying cash dividend in the present or paying an increased dividend at a later stage. Basically, there are 4 types of dividend policies: regular dividend policy, irregular dividend policy, stable dividend policy, no dividend policy. Dividend is the sum of money paid regularly, it could be annually or otherwise, by a company to its shareholders out of its profits. Payout ratio is that fraction or percentage of earnings paid to shareholders as dividend. Basic types of dividend payouts: cash dividend, stock dividend, scrip dividend, bonus dividend, liquidating dividend, property dividend. For the purpose of this study, cash dividends is considered because it serves as a criteria for the sample selection. Several studies have identified the importance of dividend payout ratio. For instance, Graham and Dodd, 1962, argued that it is rational for investors to want to invest in a company with high dividend payout rather than invest in a company with low or no dividend payout. Azagai and Sabapriya, 2008, argued that dividend payout ratio offers a lot of predictive ability since they show where a company is in its development. Also, Oberoi, 2014, states that dividend payout ratio helps to evaluate a company's financial health. And Aubach, 2020, states that dividend payout ratio is a critical business metrics used to determine the sustainability of a company's dividend payment. However, in spite of the noted importance or relevance of dividend payout ratios, most investors are still at dilemma as to what, how, why, and when to invest in a company. Hence, the need to provide a clearer view to shareholders on how to utilize dividend payout ratio information to their advantage. To this end, the researchers set to evaluate dividend payout trend in the manufacturing companies in Nigeria, having assumed a sector that have attracted investors from both local and foreign countries in recent time. Thus, the objective of this study is to evaluate trend in dividend payout ratio of listed manufacturing companies in Nigeria. The study is to cover an 11-year period from 2009 to 2019. The focus is on manufacturing companies listed on Nigerian Stock Exchange. Literature review. This study literature review is divided into 3 sections: conceptual clarification, review of related literature, theoretical framework. Thus, the review of literature in this study is in line with 4 dividend theories. Miller and Modigliani, 1958, assume prudence in the behavior of investors and argue that shareholders are basically indifferent to return in the form of dividend payout and capital gain, and hence dividend policy is irrelevant. This argument was supported by Black and Scholl, 1974. Also, Graham and Dodds, 1962, Walter, 1963, support the dividend client tree effect and argue that a rational investor will want to invest in a company with high dividend payout rather than invest in a company with low or no dividend pay. Their argument was supported by Swabe, 2006, Kapor, 2009, and Mosa, 2009. On the other hand, Redford and Gordon, 1980, Bloom, 1980, Morgan, 1982, support the tax preference theory and contend that increase in dividend payout ratio can lead to a decline in the shareholders' wealth, judging from taxation point of view. And their argument was also supported by Papianos and Savares, 1992. On another hand, Littner, 1956, and Gordon, 1960, supports the bird in the hand theory and asserts that investors prefer a short dividend over a risky future capital gains. This is to say that an investor will prefer 1 Naira dividend paid today than 2 Naira capital gain that will be paid in the future. Thus, this study is underpinned by the bird in the hand theory. Methodology. A descriptive research design was adopted for the study. The study used secondary source of data collected from the financial reports and annual reports of sample listed manufacturing companies filed with the Nigerian Stock Exchange and Security and Exchange Commission. The population of the study is 68 listed manufacturing companies on the Nigerian Stock Exchange. Sampling techniques is stratified random sample. Thus, the strata are formed based on 5 key sectors having common characteristics. The sample size is 51 firms using filter to eliminate some of the firms that were considered suitable for the study. The filter is to choose select companies with dividend payment. This study used least square trend model as informed by Srivastava, Shannon, and Sharma, 1989. You can see the study equation 1, 2, 3, where Y represents the trend. Alpha represents the value of Y at the origin, which is constant. B, that is beta, is the average amount of change in the trend value per unit of time. And X is the value of trend line for any given period. Table 1 shows companies' annual dividend payments as compiled on the table. We can see that some companies were still paying dividend while making losses. And that is why we have negative dividend payout ratios on the table. It is not a good sign because the company may be forced to pay dividend from their existing reserves, or even have to kind of raise additional capitals to be able to pay dividend. Figure 1 shows the graph for the annual dividend payout ratio. From this graph, we can observe two changes. The changes observed on the graph demonstrates the characteristics of both circular and cyclical trend in time series data. We call it circular in the sense that the variable's value tends to rise and decline over a long period of time. The stable increase in the dividend payout ratio by firms is an example of circular trend. On the other hand, it is cyclical in the sense that there are years when dividend payout ratio was at its highest, showing above the trend line. And there are years when the payout ratio is at its lowest, touching below the trend line. And these changes is usually between 3 to 5 years. We also show the second figure, that is figure 2, the annual average dividend payout in percentage. This graph was translated into a table below that shows the number of years, the dividend payout ratio, and what was retained after the payout ratio. From 2009 to 2019. From this table, we understand that the concern of this firm is to maximize the shareholders' value. Hence, more priority is given to earnings retention than dividend payout ratio. Arguably, most investors, especially the minority shareholders who constitute over 60% of the share held, want a quick return on their investment in the form of dividend payout, because dividend payout is the only way shareholders can get cash on their investment without having to sell off their stock. However, on the other hand, other shareholders may be satisfied with board of directors' decision concerning dividend payout if there is a noticeable improvement in the wealth maximization for the shareholders. Nevertheless, they may even prefer that the firm plow back their portion of the profits into the business by giving them stock dividend to increase the wealth of the shareholders. And this action, if done, can lead to expansion of the business. Deductively, if the business is expanded, it will attract both local and foreign investors to invest in the business, and consequently can increase employment opportunities. It can generate revenue for the government through taxation, which can be used to provide basic necessities like road reconstruction, provision of pipe-borne water, rehabilitation of public schools, rehabilitation of basic health facilities for the well-being of not just the shareholders, but the public at large. And this decision to reinvest may in turn reduce crime in the society and make avail enabling business environments. Having looked at trend analysis using graph, we feel it is necessary to also devise a mathematical way of calculating the trend line. To overcome the graph approach defect, the above mathematical approach was used to get an unbiased fit of the straight line to a series of data used in the study by adopting the least square method. Because according to the Markov theorem, the line suited by the method of least square is the line of perfect match in the specific sense for a particular criterion. Therefore, trend analysis, on the other hand, is concerned not only with detecting the previous growth pattern of a series, but also with anticipating future trend values. Conclusively, it is noticed that some firm has negative dividend payout ratio. It is not a good sign because the corporation would have to pay dividend to the stakeholders using their existing cash or raise additional capital. However, this study found that the manufacturing company's dividend payout ratio has a combination of stable dividend payout ratio and negative dividend payout ratio amongst companies from 2009 through 2019. This study observes cases of a decrease in the dividend payout, and this decrease is significant as it has caused some havoc in the dividend payout ratio. However, this study can settle that the manufacturing companies do have a low but steady dividend payout ratio. The implication. This study offers an insight to the shareholders of manufacturing firms in Nigeria that trend analysis of dividend payout ratio is a good measure of how well a company is performing financially in view of elements such as market fluctuation, the need for investment for expansion purposes, and how a company is recognized in the share market. Hence, prospective shareholders should want a complete assessment of the corporation performance rather than just judging the companies based on its annual dividend payout ratio. Thank you very much for the opportunity to present at this conference. Thank you very much for listening.